I believe I'm still bullish on gold. I still think gold can move higher over the next 1, 2 months and maybe even push up to 3,000. It might have one more push higher here. So I am neutral to bullish over the next 1 to 2 months for gold. I do think when the economy changes and turns and things start to sell off, I believe gold will have a pullback. And we did see it pull back about 34% in 2008. And the upside target somewhere, gold could reach to about 3,050. It'll be settling right into this last breakout. And then it'll be the kind of probably the last major opportunity to get back into gold, very similar to over here, where we go into a 3, 4, 5 year rally where gold could, go 3, 5, $10,000.
Recent technical analysis suggests gold could be positioning for significant moves ahead, though the path may not be straight up. ChrisVermeulen, chief market strategist of the Technical Traders, anticipates a potential short-term pullback that could present an attractive entry point for investors, with prices ultimately targeting beyond $3,050 in the longer term. The precious metal recently demonstrated technical strength by breaking above a key trendline, reaching $2,698 and completing a 78.6% retracement at $2,695. This technical milestone has raised questions about whether the momentum can sustain new highs or if selling pressure will emerge, leading to a period of retracement or consolidation. The weekly chart presents a decidedly bullish outlook, with gold achieving a 3-week high and poised to record its highest weekly close in 7 weeks. Gold's strong finish to the week is particularly noteworthy, as it likely closed in the upper third of the weekly range, a technical indication that often precedes continued strength. Market dynamics appear to support gold's traditional role as a safe haven asset. Vermeulen points out that historically, gold price rallies have served as early warning indicators for economic turbulence. The current environment seems to follow this pattern, with investors increasingly turning to gold amid growing concerns about various asset classes and banking sector stability. While the near-term outlook remains bullish, Vermeulen anticipates some selling pressure could emerge either later this year or in early 2025. However, this potential pullback is expected to set the stage for a robust rebound, potentially driving prices to new heights. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
In terms of gold, if we were to, we've had this big move up in gold after a multi-year pause. We had the same just before 2008. We had a multi-year pause. During this pause in gold, stocks and real estate took off. Nobody wanted boring gold. They went elsewhere. But then suddenly people got nervous and they cashed out of everything else. They start to move into gold to get it out of the financial system because they're worried about currencies and banks and bankruptcies and falling stock prices. Well, we've seen that right now. What we'll be looking for eventually is for gold to put in a bottom first and high volume and panic selling in the stock market. And that'll probably be one of our early warning signs that, hey, the bottom's getting close. When volume spikes, that means it's a herd mentality. Everybody's like blowing a fuse at the same time. They're panicking out. And we'll probably see sharp drops in a lot of stocks where there will be no liquidity. Like no one wants to buy, but everybody wants to sell. And so we'll have very sharp, big, long red bars on a bunch of stocks and indexes. So that'll be kind of what we're looking for. It's always darkest before dawn, right? So there won't be any good news and the market will put in a strong bottom and people will all think it's just a bounce, but it'll be the bottom because the market bottoms before the economy and for the good news. I think it's false. I think gold is still a barometer of hard times. I think it's telling us inflation's here. I think it's telling us people are worried. We have to wait because it will rally now before the chaos hits. And then the chaos will hit and we'll be like, oh man, gold was totally warning us again. So I believe it's a warning indicator. Yes, it has been rallying like a risk on asset, but that's what it does in this phase of the market where people are nervous of all asset classes. They're even worried to have money just sitting in a bank because we know banks can now go bankrupt. Gold to me is kind of the ultimate safe haven if you get into physical. I mean, even holding ETFs, I'm not sure how safe, the whole financial system is. And there was that really good story I've shared on here before where when the internet went out in Canada a couple of years ago, I met a guy who ended up filling his car up with silver rounds with gas, and it's amazing. And this is to me is where Bitcoin and gold have this huge divide. Like what happens? Like we go into war where there's huge EMP and electronics go down, the internets get taken down, there's no power or whatever.
Hmm.
Like cryptocurrencies, don't have a whole lot of weighting. Whereas if you've got a couple gold rounds or silver rounds on you, you still have bargaining power. So as much as crypto has got so many uses and people trade it and see it as an investment, I think when all hell breaks loose, precious metals are still that safe haven play. And I believe they're going to like show their time, and that they're kind of the one asset class that it doesn't just disappear. It can't really just get stolen digitally and all that stuff. But right now, the stage that we're in is still favorable for precious metals. And the cycle chart that I have here shows that typically we see gold and energy stocks, both do very well as the stock market is trying to put in a peak. And we're seeing both gold and energy stocks have been on fire, trading near and at all-time highs. So because we're in this stage, it's a long-term cycle.
U.S. stock markets experienced significant downward pressure as investors grappled with multiple concerns, including the approaching presidential transition and persistent inflation worries. The major indexes, the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite, each declined more than 1% as market participants reassessed their positions. Friday's robust employment data presented a paradox for investors, as substantial job numbers potentially signal the Federal Reserve may maintain higher interest rates for an extended period. This interpretation contributed to the day's market decline, highlighting the complex relationship between economic strength and market performance. The approaching release of U.S. inflation data next week has heightened market tension, particularly as it coincides with rising Treasury yields and uncertainty surrounding Donald Trump's upcoming policy initiatives. These factors create a challenging environment for investors attempting to position their portfolios for the presidential transition period. ChrisVermeulen, noted market strategist, has identified concerning technical patterns in major indexes. His analysis of the Nasdaq suggests institutional investors are reducing their market exposure, a development that often precedes further market weakness. Similarly, the S&P 500 displays bearish technical formations that, according to Vermeulen, warrant caution regardless of underlying economic indicators. Let's get back to the interview.
I think it is. So if we take a look at this kind of mixed indicator, this is the SP 500 equal weighted. So it's not tech heavy. It's the small cap stocks and it's the micro cap stocks. And if we just look at it, we can see it's gone into a huge sell off. It's got a bear flag pattern and now it's breaking down, and it shows we could have the markets really collapse. And the reality is a 60-40 portfolio since the high in 2022 hasn't made any gains. You're actually at a loss over the past like 2 years. And that's telling us that the majority of stocks aren't doing very well. So I think people need to be aware, if you look at the high yield dividend stocks, like this is the SP 500 high yield dividend stocks. This is what most investors are invested in. They all hold big dividend stocks. They have dropped. They got this tight bear flag pattern. It is showing we could see a huge drop in dividend stocks. And the crazy part is the SP 500 is down like 3 or 4%. And we're seeing the dividend stocks, which are supposed to be safe havens, high yield, safe plays, they're down like 3-4 times what the SP 500 is down. And it just goes to show money is definitely flowing out of this market. While we see the indexes going up, when you look underneath the hood, we have investors rotating out. Warren Buffett continues to load up on cash. He's liquidating positions. BlackRock is selling off, I think, lots of real estate. They're huge holders in real estate. They're selling real estate at losses. And we don't really hear much about it because I think these big players have so much weighting in it. They're just trying to get rid of real estate before the real estate bubble breaks. But I think overall, this market is not nearly as strong as people think. And I think we're going to have another sharp leg down. And the monthly chart of the SP 500, as you and I were just talking before we hopped on this call, David, is really, really important, I think, for people to understand. And I use Fibonacci extensions. It's the most powerful tool, the simplest tool to predict upside targets and pullbacks.
Yeah.
And based on the rally that we had to 2022 high down to the 2022 low, we can drag that forward to where that price is. And the SP 500 came up in December tag that level, and now we're starting to roll over. Now, this same chart pattern has happened on gold. It's hit 100% measured move, and Bitcoin. So we have equities, gold, and Bitcoin all doing the same thing on the monthly charts. So that is a very powerful sign, a warning sign that the end may be closer than we think. And as you just mentioned, I think this could be the start of a much bigger correction. I think we could see a big pullback of potentially 15 to 25%. And then, depending if the market can hold that, we might actually see another much larger drop after that. I think this year is going to be a very tough year for investors and anyone holding equities.
As markets navigate through layers of uncertainty, the intricate interplay of technical signals and macroeconomic developments continues to shape the investment landscape. Gold's strategic movements reflect its enduring value as a hedge and the evolving sentiment tied to broader economic shifts. While challenges remain, the potential for new opportunities amidst anticipated market adjustments highlights the need for adaptability in investment strategies. How do you foresee the evolving global economic climate impacting gold's role as a key financial instrument in the near term? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.